Hi everyone. Today let's talk about Fundrise. We'll start off with their thoughts on the economic slowdown. Then we'll talk about one of their articles that talks about the banking crisis. And then we'll go through current returns as well as each fund and how they performed over the last quarter. If you like passive investing and making money, definitely like and subscribe. I do quarterly updates on Fundrise to review my performance and to help you guys make better investing decisions. So definitely hit the bell so you don't miss out on any future episodes. Welcome to the Portfolio Bulletin. Let's get started. So Fundrise thinks that we are in the final stages of a downturn, and they call that the ring of fire. They expect to be able to continue to take advantage of these opportunities as they see more market volatility and financial distress, as well as financial distress. They start off by talking about returns for their various funds. They say the flagship fund returned 0.56% in first quarter. Income fund returned 2.13% with an annual dividend return of 8.4%. So pretty good on the dividend returns here for the income fund. This is a pretty new fund. They combined some other funds into it to make one consolidated dividend specific fund. And I will be buying more of that fund specifically. We'll talk about that later. But overall, not a bad return here for Fundrise, but we'll see that my accounts didn't do quite as well as what they're saying here. They then reference the banking crisis that we've talked about and how it was something that they didn't necessarily expect to happen, but they did mention that it's typical of a debt cycle where you generally have some institutions that cannot survive the downturn. And in this case, it was Silicon Valley Bank. And then they move on here talking about how they expect to move into the last phase of this downturn where people begin to act out of fear and that we see greater sell-offs in the markets. We'll see if that ends up happening. The markets have been resilient here recently, going sideways, but it is something that they are forecasting, so it's interesting to see here. Then they reference the bank runs that we saw with Silicon Valley Bank. The bank actually was in fairly decent shape, but then when they got those huge bank runs, they obviously weren't able to meet all of the withdrawal requests, and that was basically the downturn. And then they move on to say history rhymes. So we're not seeing the same huge crisis that we saw in 2008, but we are seeing similar where we did have some banking failures. We've talked about this many times, so I don't want to go too deep into it, but it just doesn't seem like this is anything near the 2008 crisis, and it seems fairly limited at this point. It does make sense that Fundrise is referencing it, though. Fundrise tends to be a pretty conservative institution, and it makes sense that they're staying on the conservative side and that there could be more credit risk, and that's how they're approaching the current investing environment. And they also say that this is coming at the end of arguably the longest bull run in U.S. history, about 15 years in total, and it has been propped up by extraordinary measures and extraordinary expansions of monetary policy. And now we're at the point where the Fed is having to pay penance with their high rates. They're having to remove money effectively out of the economy to help reduce inflation, and this is generally a result of the quantitative easing that they've done in the past. They mentioned that current market equity is much less than current debt, and that we're probably going to move into a situation where we're going to have to address some of this debt, and that's going to affect equities. And then they go into their spiel where they talk about how they are conservative, they use then is normal for a fund like this, and how that is intentional. They mention this in just about every quarterly update and annual letter. It's a very conservative organization, and so far that has paid off. They've done very well. They massively outperformed in 2022, despite some losses at the end of the year, but not anywhere near what we saw in the equity markets. So overall, they're still doing quite well, and they continue to mention that fact here. And then they go into the appendices where they talk about how much money they have on hand in each fund and current net returns based on those funds. Moving over to the article talking about the banking crisis from the Wall Street Journal on Fundrise. I'm not going to go through the whole thing, but they highlight the fact that U.S. lending is going to decline by 1% due to the banking crisis. Obviously, that's going to make it tougher for growth and tougher for the markets to go higher when businesses can't get loans, which is going to make it more difficult for them to grow. This also makes it tougher for the individual to buy these goods, and generally, we expect the economy to grow at a slow rate. They mention here we expect the economy to grow by 1.6% this year, which is slower than the 2.1% from last year, and the global economy is only expected to grow at 2.8%, which is a significant slowdown from the 3.4% last year. So everything is slowing down across the globe. It's not unique to the United States, and that the collapse of Silicon Valley Bank was a symptom of this economic slowing. They also mentioned that Congress still needs to raise the debt limit so that the United States can pay for its debts. Kind of counterintuitive there. We have to raise our debt limit so that we can pay our debts. But of course, they say that this is going to be fine. And Janet Yellen says, don't worry about it. We're all good. Moving over to my accounts here, you can see net value just a hair under 65,000. Vast majority of that is in their real estate funds, almost 79%. 24% is in their venture capital fund, as well as their Fundrise IPO here. So pretty decent amount across these two funds. Only 5,000 in their venture capital fund, which did have a slight return, which is nice to see. But the Fundrise IPO is where most of this money is. I put in 10,600 and they say it's currently worth 16,600. And then you can see my real estate holding here, 49,311. The vast majority of that is in growth, but I am going to start buying more of this income real estate. And then looking at returns here, let's go custom, go 2023 for Q1. And you can see my net returns were actually minus $32.60. Dividends, $108. Appreciation, down $140, which is pretty interesting. When we look at the previous quarter, you can see appreciation was down quite a bit as well, but they paid a massive dividend to help counteract some of that. And then so far here in Q2, you can see small profit, just about offsetting the losses from last quarter. Overall, Fundrise is starting to slow down a little bit, but still very resilient given the economic environment. Moving over to net returns by fund for the quarter, you can see East Coast REIT, 0.5%, Growth REIT, 1.3%, Heartland, West Coast, and Growth REIT 2 struggled a little bit here. Growth REIT 3, down 2.4%, Development, down 2%. Income, you can see that big growth, the outperformer here this quarter. Flagship Fund, 0.5%, just like they talked about. And then Growth REIT 7 here at 1.5% for a weighted average of minus 0.1%, which is my annual return so far. Obviously, Q2 just started. There's only a few changes here. Income Fund leading the pack here so far on the year. And looking at that in dollars, you can see everything is pretty well dispersed. Growth REIT 2 at the biggest loser here. And you can see I don't have a lot of money in the income fund. And that's why I am going to contribute more to that fund in the future. Flagship Fund, that's one of my bigger holdings. So that 0.5% ended up being $100. So far, not too bad on the year, down just $9.27. And moving over to my Fundrise Pro account, I did activate that, and you can see here you can put in custom allocations of new funds. So 60% of my new money coming into Fundrise is going to go into the real estate fund, 25% will continue to go into the flagship fund, and then 15% here in the Growth 2 fund. Overall, I'm still happy with Fundrise. Their growth has definitely slowed, and we're seeing some losses here, but like we talked about, not nearly as bad as the stock market, and I'll continue to contribute probably a little bit less money on a monthly basis here to Fundrise, but I will still continue to grow this account. Comment down below if you are an investor with Fundrise and what you think of their platform and the changes that they've made and the returns that you've gotten. Otherwise, like and subscribe if you got any value out of this video, and make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your investing and have a great day.